Welcome to Conversations, Season 2 of the MTA podcast series, a weekly audiocast featuring interviews with leading investment strategists, geopolitical experts, and other key thought leaders, brought to you by the Market Technicians Association, and your host, Ed Carlson.
Even though strategies are model-driven, ultimately someone has to press that button in order to be able to execute the model. I see that as being the single most important thing in trading, the ability to execute the trades that are there. When you get into country ETFs, there tends to be even less risk. Outside of Iceland, countries just don't go out of business. We'll ask today's guest whether he still believes that or not, and many other questions. Today, Tuesday, November 30th, 2010, this is Conversations, the official MTA podcast series. And today's guest is Larry Connors. Larry Connors, CEO and co-founder of Trading Markets in the Connors Group. Larry Connors has over 28 years' experience working in the financial markets industry. He started his career in 1982 at Merrill Lynch and later moved on to become a vice president with Donaldson, Lufkin, and Jenrette. Mr. Connors has built two multi-million-dollar companies since 1995. He has also successfully managed money since 1994 in two separate private partnerships. Mr. Connors has authored top-selling books on market strategies and volatility trading, including How Markets Really Work and Street Smarts with Linda Raschke. Street Smarts was selected by Technical Analysis of Stocks and Commodities magazine as one of the classics for trading books written in the 20th century. His latest book, High Probability ETF Trading, was selected by SFO magazine as one of the 10 best investment and trading books for 2009. His books have been translated into German, Italian, Spanish, Russian, Japanese, and Chinese. Mr. Connors' opinions and insights have been featured and quoted in the Wall Street Journal, New York Times, Barron's, Investment Business Daily, Bloomberg TV and Radio, Bloomberg Magazine, Dow Jones. Oh, I give up. Larry Connors, welcome to the program.
Thank you, Ed.
Well, thank you. You bet. We are just really excited to have you with us today. Larry, we always start these podcasts with a little personal background. Why don't you give us just a minute on where you grew up, where you went to school, university, that sort of thing.
Grew up in Boston, went to school at Syracuse, came out of Syracuse, and went to work shortly thereafter with Merrill Lynch in Boston, and pretty much have spent my entire professional life in the financial markets.
Okay. So you were hired by Merrill in 1982, I assume, as a broker?
Correct.
Okay, and so you've written, or I read somewhere, that you made the decision to become a full-time trader in 1987, but you didn't actually get started. When was it you got started?
94. It took 7 years to get there. At the time, it's hard to believe now because there's so much information out there. But back in the late 80s and the early 90s, and some of your more veteran members will remember this. Real traders didn't discuss how they traded. They certainly didn't put things in writing, and it was extremely difficult to learn from others. Today, it's now there's a proliferation of information that's out there, and the path is much faster. But back in 1987, it took 7 years to get to that point where I felt I could support my family by being able to by trading on a full-time basis.
So all that time, were you still a broker?
I worked at Merrill, finished up at Donaldson, Lufkin, and Jenrette, and kind of viewed Merrill Lynch as my undergraduate, and my graduate degree was at DLJ. DLJ really taught the proper way to look at markets and how markets worked, at least at that period of time.
Interesting. Okay. You know what? I know I'm going to forget this if I don't get back to it right now. I was kind of joking, but kind of actually half serious also when I quoted you saying outside of Iceland, countries just don't go out of business. Do you still adhere to that view?
Yeah, it's interesting as we talked about this today because Spain and Portugal are now on the list of countries that may go out of business, and then Ireland over the weekend. It's I think the world has certainly changed a little bit by that. But when I take a look from a tops-down approach in looking at an exposure level, or at least a risk level when putting together a portfolio, I would still prefer to be in a major ETF as opposed to an individual stock. It's just the risks have changed a little bit, but the risks in individual stocks are still greater than a risk in an individual ETF, especially when you get into some of the larger, more established ETFs within the sectors or within those countries.
Oh, well, absolutely. There are still some points of asset allocation that still have survived the last couple of years. Obviously, you get rid of your company-specific risk, or at least diversify it with an ETF. I'm trying to remember. That seems like it should take me right to a point I wanted to ask you about. I'm looking through my notes. Here it is. You've warned traders to be aware of the so-called correlation risk and said that that was the reason why so many money merchants failed in 2008. Yet you've also said that you might have 20, 30, 40, even 50 positions on at once. Now, putting aside for a moment I would call it the Herculean task of trying to manage 50 positions, in a market where everything seems highly correlated, what good does it do to have so many positions?
Yeah, we take an approach that when we're building portfolios and when we're managing our own money, we're looking at three things. We want to have a portfolio that's long and short, or at least has the ability to go long and short. So the strategies that are both on the long side and the short side. We want to be in equities and ETFs. We know that the behavior is different, a little bit different between the equities and the ETFs. And we also, for many years, we were mostly mean reversion traders. And the majority of the research that I've published has been mean reversion in nature. And you can see historically how the edges have continued to hold up on a mean reversion basis. What we've now added is trend following to our own portfolios, whereas we've been able to quantify trend following methodologies that allow us to get into positions and then stay in the positions with a longer term trend. So that's somewhat newer to us. We started we've had the trend following research for a number of years. We put it into a portfolio form within our software product, the machine, this summer, and started adding the trend following positions to our own portfolio. Beginning, I think we did our first ones in July, and in fact, are still holding on to some of those positions that we had placed onto July. But in looking at building and constructing a portfolio, again, it's long, short, to looking to take advantage of the times the markets are rising and the declining, equities and ETFs, and then a combination of short-term and then also which would be mean reversion, and then longer term, which would tend to be trend following.
Okay, that actually brings up two questions. But first, we're going to continue with Larry Connors in a moment. But first, a reminder that on next week's program, we'll have former Merrill Lynch analyst and current author of the Fred Report, Fred Meisner. Okay, you mentioned mean reversion, and I know that's been a big part of your trading strategy for a long time. For example, you like to say, buy into weakness and sell into strength. That sort of statement sounds very enticing to new students of the market, but isn't it true that approach works until it doesn't? I mean, there's got to be more to your success than what's contained in that simple statement, right?
Yeah, it's first of all, I'll take a step back and basically say that pretty much the majority of things that we do, we want to have statistical evidence that that behavior exists. So when we're quantifying strategies, we're looking back. The shortest that we're going to usually look back is to 2001. Internally, we'll go back even further to 1995. We've had things that will go back as far as 1989, and even on some of our tests, we've gone back approximately 100 years looking at the Dow on certain type of strategies. What we see consistently is that on a short-term basis, stocks and ETFs, especially ETFs that are above the 200-day moving average, when they pull back, they tend to provide edges. Historically, they provide edges to the long side. And when they're below the 200-day moving average, the edges tend to be on the short side. So ideally, if you set up a portfolio where you're looking to be long stocks or ETFs that are pulled back that are above the 200-day, and then have identifiable points where you're exiting, and you have statistics to be able to guide you. And for us, our sample sizes are large. We like to look at large sample sizes. You get to see the same behavior over and over again. So this is behavior that, for example, Linda and I were writing about this, Linda Reschke and I were writing about this in the 90s. You see this behavior continuing to hold up throughout the 90s, then into the last decade, throughout the 2000s. And what the one step that we've been able to do is we've been able now to go further and be able to quantify that behavior. And when you start looking at software products like the machine that we released earlier this year, and we have the ability to have over 36,000 strategy variations built into the machine, God. And then be able to instantly calculate what the historical results are by putting all those variations together, you're able to build high performing type of portfolios, at least on a look back basis. But the key thing there, you will see over and over again, the biggest edges have been exhibited on stocks and ETFs that have pulled back. When they're above the 200-day, they pull back to identifiable levels and then exit into strength. And on the short side, looking to sell into strength and buy back into the pullbacks.
Mm-hmm. Wow. 30, would you say 35,000?
Over 36,000 in rising. 36,000
what? Models?
Strategy variations, yes.
Strategy. Wow. Gotta write that one down.
Yeah, the users can, in fact, Mike Carr did a nice write-up of the machine in the October issue of your magazine.
I think I saw that.
Yeah, it was very nice. So Mike did a nice review of it, and the traders have the ability to go in and take the strategies, build the strategies based upon what they're trying to accomplish. And one of the key themes, though, what you'll see over and over again, is that buying on pullbacks and selling into strength has historically held up. The things that Linda and I, for example, wrote about, as I mentioned, in the 90s, and we continue to publish in a number of books in early 2000 and then through the mid-2000s, still continue to hold up today at the end of 2010.
Okay, all right. Now, through all your explanation there, you kept referring to we. You've got a team working with you, don't you? And some of them have some high-powered background in statistical analysis. Isn't that right? Can you tell us a little bit about your team?
Yes. My main partner on the research side is a gentleman by the name of Cesar Alvarez. He was one of the started off as a junior team member at Excel at Microsoft and finished off as a senior team member and throughout the 90s. So he has strong computing capabilities. Obviously, he left basically retired from Microsoft at a fairly young age to manage his own money and was a client of ours for a number of years. Then he came to us and said, I think I can add to the research process. And it was probably an understatement on his part. He's greatly enhanced to the research project. We also have another gentleman on staff, David Wildmonster. And David, strong statistical background, strong math background, has 2 degrees from MIT, another full-time trader. So he's someone who's able to not only these gentlemen are not only able to do the heavy lifting when it comes to math and statistics, but because they manage their own money, they understand how markets work, so they're able to put the two together. And I think that's a key component there. Someone who has a strong math, science, engineering background that also understands trading has I feel has a very large advantage of being able to go in and build proper trading strategies and proper portfolios that they can manage for themselves.
Mm-hmm. Larry, we've spent just about 15 minutes so far in our discussion, and given everything you've said, I think the most surprising thing our listeners could expect to hear is the following quote I took from you. Quote, "So I suggest that for anybody who wants to learn how to trade, do it by hand. Early on, do it by hand. It's the single best thing you can do." That sure doesn't sound like somebody using a lot of statistical computer work.
Yeah, I used to and still do. We still do. Our process begins by hand. In fact, we were just began a research project last night, and it started by hand. I did it by hand myself before I sent it up to the research team. And by doing it by hand, it essentially allows one to understand the behavior of what's going on. So if someone makes an observation, I'll use daily bars, for example. I'll either use daily bars or I'll use just the closing prices. I'll focus on one or the other. But if I'm looking at behavior and closing bars, what I'm beginning to do is beginning to track the test results. And I'm doing it by hand. And I'll go through different periods of time to be able to do that. And if I start seeing behavior falling in line with my expectations, then I bring it up to the research staff. But by doing it by hand, it allows one to go deeper. What happens is that We're not looking to do any data mining. We're not looking to do anything that really is going through a data optimization process. What I want is I want inherent behavior to be in place. If you take a look at the things that we've been teaching now and been publishing for over a decade and a half, the majority of it still stems from the point of buying up pullbacks and selling it to strength, then going in and being able to have the statistical evidence there just supports that basic premise. The statistics support the philosophy.
So let me see if I can sum that up. You start with, say, what's the word? An a priori idea, something that you have in your mind. You do maybe a visual examination, see if it makes sense, and then you send it to the team for statistical confirmation.
Yeah, it's an observation which I'll then hand the test results on, and then from there, maybe they'll do the heavy lifting from there, and we'll go in. We have our database. We have over 10 million trades. We have over 10 million trade points within our database, and that goes back to 1995. So when we're able to go in there and look at that behavior, we're able to see things on large sample sizes, meaning if something is showing up 15 or 20 times, it probably doesn't mean a great deal to us, but if something is showing up hundreds, if not thousands of times, then it does mean something to us. And then what we'll do is break it down on a year-by-year basis. We want to see a consistent performance. We want to see it performing both in bull markets and in bear markets. We want to see it performing in high volatility markets and low volatility markets. We want to take that all into account. We just don't want to see behavior that, for example, performed well in 2008 or 2001 and 2002 because they were bear market years. We want to see the behavior hold consistent year after year, no matter what the market environment was.
You know, speaking of behavior, here's another quote from you. Markets do change. What doesn't change is human behavior. Larry Connors, tell us what you mean by that and how you would apply it on a day-to-day basis.
The human behavior is still, there's still, people talk about fear and greed, but I do believe that the fear is far greater than the greed in the marketplace, and that's inherent. People are still people, and
right.
We're all human. There's many centuries of wiring that goes into all of us, and it's just not gonna change. And you see the same behavior occurring over and over again. It's by the fact that computers are playing a larger role in the marketplace. You would think that the things that we saw and tested, for example, and published in 2002, 2003, and 2004, you'd think it would have changed, especially with all the computer trading going on. Not only have we not seen any fundamental change, but in a number of cases, we've seen an improvement in the test results since we've published some of the findings. So typically when people publish things, the test results will tend to move in the opposite direction. That does occasionally happen, but what we've seen also is we've seen a number of cases where the test results have gotten even better up through today.
Okay. We're coming into the last couple minutes of our interview today, Larry. And before we go, I wanted to ask you about something a little more general, maybe a little more personal. I know you credit Larry Williams as an influence. Who else might you mention has influenced your trading and why?
Yeah, I could probably answer this. There's probably too many people to mention. Let me mention on the research side of it. Certainly, Larry was well ahead of everyone. He did things that were years ahead of everyone. A gentleman whose name is not mentioned as often as it should be mentioned as well as Wilder, from his book back in the 70s. If you take a look at some of Wilder's work, especially conceptually, the things you were doing were very correct. We greatly rely upon, for example, the 2-period RSI. We've been publishing research on the 2-period RSI for over 8 years now. Wilder created the RSI. He essentially used the default of a 14-period. We've never seen much statistical evidence that a 14-period has an edge, but when you shorten that period to 2-period or 3-period, you start seeing edges occur. But Wilder still created that. And then you take a look at people on the trading side, some of the people that I've been associated with. Kevin Haggerty, who was the head of trading for Fidelity Capital Markets, co-founded Trading Markets with me. Someone who had 92 traders working for him over at Fidelity, really has an incredible insight in the marketplace. Tony Saliba is another gentleman off the option side. Tony was one of the original market wizards, was the only options trader in Jack Schwager's book, Market Wizards. Tony and I still remain in touch with each other on a pretty continuous basis, and his insights into the way markets work, especially in the options market, has always been very helpful. Linda, who co-wrote Street Smarts, certainly great influence and a tremendous trader. So I could go on and on. There are a lot of smart, great people, and many of them are members of the MTA. And another one, John Bollinger. We published research on Percent B. We would not have been able to publish our Percent B had John not created Bollinger Bands. So you see, we all, people talk about walking on the shoulders of giants. I mean, we very much view ourselves as having the ability been fortunate enough to have the ability to learn from many of the people that are out there, and especially many of the members who are some of the veterans of the MTA. It's been tremendous.
Yeah. Oh, that's great. You know what? We're a minute over, actually. Real quickly, any favorite books that you would recommend?
Favorite books?
Anything in particular?
I'm going to probably tell you something that I'll give you a book that probably other people don't mention.
Okay,
it's probably
great.
A book that's influenced me tremendously.
That's what I'm looking for.
It's a book called Trading Risk, written by Ken Grant. Ken was the risk manager for Tudor Jones. He was also a lead risk manager, I believe, lead risk manager for SAC and a number of other hedge funds. But he was Tudor Jones' risk manager. And Ken wrote the book about 6 years ago, and it remains in print. And I recommend this book to everybody. In fact, I'm rereading the book now probably for the fourth time, and every time I read the book, I learn something new. So again, the title is Trading Risk, and Ken Grant is the author. And I believe it's available, now it's available on Kindle on Amazon, which is great.
Okay, all right. Hey, speaking of great, Larry Connors, it's been great having you with us today. Before we go, is there anything else you'd like to mention?
I appreciate the opportunity to do this, and if anybody has any questions on this, they can feel free that they can email me. My email address is l.connors@tradingmarkets.com. So feel free to email me, put in the subject line MTA, so I know it's from an MTA member, and I'll make sure I'll get an answer back as quickly as possible.
Oh, that's fantastic, and that's a great way to wrap it up. Today's guest has been Larry Connors, and that wraps up this week's MTA podcast. From SeattleTechnicalAdvisors.com, I'm Ed Carlson, together with our recording engineer, Shane Squark, in New York City. Say goodbye, Shane.
See you next week, everybody.
All right, let's keep our stops tight. Good day.